What's going on, guys? Welcome into today's show. I've got Bill Kanatas from Self-Storage Developers. He is the co-founder and CEO of the organization and leads the company's strategic growth in site acquisition, investment initiatives, and focusing on developing Class A self-storage facilities for national operators like Public Storage, Extra Space Storage, and Life Storage. And we basically kind of give a full masterclass today on commercial real estate development, specifically for self-storage, how he finds these sites, what they do in terms of market research and studies, how they entitle them, how they go and structure and engineer the capital stacks for raising money and getting debt to build these properties out, and then how they manage and operate them, what the returns look like. You're going to get everything on their model today. And from a seasoned real estate developer like Bill, some great wisdom and insights on how you can make sure you don't make a lot of the mistakes that self-storage investors or developers oftentimes make, how you can crush it using this model and vehicle, whether it's for self-storage or just understanding a little bit more of the development process as a real estate investor, if that's something of interest to you. Also, just things to understand and expect if you're going to be a passive investor in a syndication like what they do, and understanding what kind of returns to expect, some of the timelines, some of the things that you're really going to want to understand if you're looking to be a passive investor. So a great, insightful episode today on all things development, all things self-storage. And let's go ahead and dive in with Bill Kanatas from Self-Storage Developers. Bill Kanatas, welcome to the show, brother.
Hey, Matt, thank you for having me on today.
So you've got quite an extensive journey in real estate investing, starting off kind of in the single family world and breaking into the commercial world, doing storage developments, which obviously is kind of the core focus of your business today. And we'll be breaking down that business model and kind of what storage investing looks like in 2025. How the heck did you get started in real estate investing?
Wow, that is a long story and a long journey. So I won't bore your listeners. I'll tell it to you as fast as I can. My wife used to be a paralegal for an attorney, and they did real estate closings. So through that, she got me a job to be a title agent, which I liked. I was in between a couple of jobs. We're talking about 1999, so a long time ago. And I told her I wanted to buy our first investment property. And she suggested that I go and talk to somebody that they work with that does all the mortgages for, their law firm. So I went and saw them. It was back in 1999, and the firm was called Bankers Nationwide Mortgage. And I remember it. There's a story behind that. So I walked in looking to get a mortgage, and to my surprise, I walked out with a job. So the guy that owned it was looking for somebody that was young and aggressive, and he wanted to teach the business too. And I thought, making loans would be kind of fun. But the hook he gave me was, if you come work for me, I'll show you how to buy this house with no money down. Well, I just got married a couple of years earlier, and this is our first investment property, and all I had to hear is no money down, and I was all in, right?
Yeah.
So we did our first loan. The house we purchased, we bought it in my wife's name, so it was in her name. I was the loan officer on it, so easily you'd make a commission, obviously, for doing the loan. And back then, they had a lot of, incentives for first-time home buyers. So by the time we got to the closing table, I actually walked away with a check. So I said to myself, hey, what a great business, right? I could be working 40 hours a week doing closings, or I can be flipping houses and be a landlord. So that was my first entree into real estate investing. And I worked for the mortgage company for about a year. And while I was there, I really liked the business and I wanted to see it grow. We had computers back then, and I wanted to automate more things, but my boss didn't want automation. So jokingly, I said to him one day, how about I buy the company? And he said, buy me out. So I got to my first investor, asked him for $100,000, and he trusted me and gave it to me. And I purchased the company in late 1999, and I started loaning money. And then we saw all these builders coming through and other developers that were looking for financing for their projects. And from there, my partner at the time, I had just purchased a house. And when he got to the closing table, he couldn't close on the loan. So he called me up and he said, hey, you won't believe this. I can't close on my loan today because the builder owes $50,000 lien. And he says it's been paid, but doesn't have the lien waiver. As a result, he can't close on it. And he's got a truck there and he needs to move to his apartment. And he said, can you bring me $50,000? And I said, sure. So we went over there. brought him $50,000. And the next day, the developer came to our office to pay us back the $50,000 that we advanced him. And he said, "Hey, do you guys want to get involved in developing? I'm looking for some partners. You guys could be my finance partners." So we said, "Sure." So we shortly thereafter started developing single family homes. So we would buy the land, we bring in the water, the sewer, and the streets, and then we would sell off the lots to other general contractors who were building one-off homes. And the best part of that is, we basically land banked it. And every time there was a closing, we'd get a portion of that to buy down our loan. And then we'd get money that they would pay us as a fee. So did that for a while. And after that, I saw retail and we said, "Hey, this can't be hard. We're doing residential homes. How hard can it be to build a strip center?" So we started building strip centers and we did retail strip centers. We did most of the projects here in the Chicagoland area, but we did one in St. Petersburg, Florida. That was really fun. And from that, we decided to start loaning money out to other developers. So we started a hard money fund. So we're loaning money to other people that are looking to finance and rolled with that till about 2007 or eight. And I don't know if you remember 2007 or eight, but there was a big punch that came across and hit us all across the head, all of us developers, which is fine. When I tell my stories, I tell people, you got to climb up the ladder and you got to fall back down. And the guys that get up and keep doing it over and over and over again are the ones that succeed in life. So then continue the journey. From there, we bought a couple of retail strip centers that needed to be repositioned, and we repositioned them. My background was in development, so I was able to subdivide these properties and sell off the assets individually. And from there, we got into car washes. Go figure. And buddy of mine came up to us one day and said, "Hey, we're looking to raise some capital to build some car washes." And I go, "You can't really make a lot of money in car washes, can you?" Little did I know. And no, you can't make good money in car washes. So we developed some car washes and we got four of them off the ground and they did very, very well. And then private equity came in and purchased our shares out. And today they have, I think, about 12 or 14 that are operational. And they gave us the opportunity to cash out and get involved in something else. And it brought us to self-storage. So here we are today.
How did you decide to land on self-storage? Out of all the asset classes you've been in and out of, and the journey of being the bank and being the developer and, different asset types, what landed you in self-storage and why have you decided to stay there and make this the next part of your commercial real estate investing journey?
Yeah, that's a great question. So I've always liked multifamily and I've owned some multifamily myself. What I don't like about multifamily is getting that call that, my toilet's not working or it's too hot or it's too cold or the tenant upstairs is making all this noise. And then the worst part of it all is, there's tenant rights, which I believe is a great thing, right? Tenants do need to have rights, especially if they're in a building with a slum landlord. And that's one of the reasons that they're in place, right? But there's two sides to that coin. Sometimes you have a great landlord and you may not have such a great tenant. And with a multifamily, you'd have, sometimes you have to go to court and you have to evict people. Then you feel bad that you're asking somebody to leave from their home or you have to throw them out in the wintertime. So that took a lot of brain damage. And when you have investors, it was difficult to then not being able to give them their IRRs or what you promised them because you just can't get these tenants to pay on time. So we were looking for another asset class that had tenants, but the tenant rights were more on the owner and it was short-term leases, right? So in our industry, you sign month to month. It's not a year-long tenant. If you don't pay, it's very simple to get you out. We basically change the locker, and if you don't pay after a certain day, it goes to auction, and eventually the people either pay or they lose their space. And in our world, we have 900 lockers. So if I lose, 10 people, it ain't going to affect me. If I lose 50 people, it's going to affect me a little bit. When you have a multifamily and you have, a 90 unit building or a 50 unit building and you lose 10 people, that's really going to affect you.
Yeah, absolutely. Now, why develop versus buy second gen or third gen, assets? A lot of people look at development and go, man, development is kind of feast or famine, right? You absolutely crush it, or you can go bankrupt. And you
Right.
have people hear those horror stories. What's the reality of that, though? Is, how many people that are developers really are, doing developments and it being a total loss and going sideways, and how many are doing it successfully, and why did you guys decide to develop versus buy second gen buildings?
Sure. Development is definitely a lot riskier. You really have to do your homework up front, right? You got to find that sweet spot in the area where we look at things that we call it per capita. So a good market is a per capita of 7 square feet or less per person in that area. And we usually look at a 3 mile metric to see what the population is in those 3 miles, what the supply is in that is in that 3 mile range. But you can find that property. And the real value to us to bring in investors is to do the development because that's where you're going to get your real bang for your buck, right? So if you can build it, I'm making this up for 10 to 12 million dollars, and you can flip out at $20 million. If you're putting 20% or even 25% down, the the multiple on the actual cash equity is greater. Also, our developments are being operated by the big boys. So we have public storage, extra space, and more than likely they're the candidate to purchase it. So they're also paying better cap rates. They're compressing them down, and they usually buy them, before the fifth year because they know what the outlook is. They know what their achieved rates are in the marketplace, and they're looking for value themselves too. So I like. There's a lot of guys that are buying, other third generations or second generation space, and they're adding value to it. I think that's a great play as well. So I'm definitely not dissing that in any way, shape, or form. But coming from a development background, I like that. It's the hunt. It's finding the right properties, putting the right team together. It's talking to the banks, getting the financing. I love models. So I'm self-taught Excel, and I just love them. I spend hours a day trying to figure out the best way to manipulate it to get the best return for the investors.
So let's kind of break that model down a little bit and help somebody understand what an average deal looks like for you guys as self-storage developers. Walk us through, when you're starting to go on the hunt again, what does that look like? What are you guys, looking for, and why? And what is kind of the initial phase of identifying the next project?
Yeah, that's a really great question. So first is the area. Like, where are people moving to? Where's the growth? Also, as we're building newer homes today, and depending on the area, most of them don't have basements anymore. So, you buy this beautiful home, and you're like, wow, this is great. And either downsizing, or maybe you're buying a house that's a little bit bigger than your last one. A lot of them don't have that extra storage that you did in traditional homes that were built in the 80s and the 90s. So we're looking for new growth, new homes. Population in a 3 mile radius would like it to be more than 50,000 people. If you get something 70,000 in a 3 mile radius, that's great. You're also looking at the medium household income. If it's 50, 60, 70,000, that's obviously a great income. And we're looking for renters, right? So who are some of the people that are going to be your clients? A lot of them are either downsizing their home and they're moving to apartments and they're looking for a place to leave their valuables, or a lot of the renters just don't have storage downstairs, so they have all the stuff that they like to keep in the storage facilities. So if there's a place that has like 30% rentals or greater, or even 25 or greater, that's also a great location. Obviously, you'd like to have traffic, but usually, for car washes, you need the traffic, right? So when you're driving to work, you're like, "Oh, my car's dirty. Let me hop in there and do it." When you're talking about, self-storage, it doesn't have to be on the way to work, but it does have to be near your home, right?
Yeah.
So it's more of a destination place. It doesn't have to be on the main road at 30 or 40 or 50,000 cars per day. However, if it's easy to get to, you got a better chance that they're going to come to your site. And we're in the Midwest. We develop in Chicago. So one of the new things that we're introducing right now is we have a full drive-through. So you drive in one end, got a speed door that closes behind you. You unload your stuff, and you can either walk down the aisles to drop off your stuff. Obviously, you have carts, or if it's on the second or third floor. But we also have units that are very, very close to that drive-in area. But it takes you out of the elements. And when you're looking at some of the older self-storage facilities that were built in the 80s or 90s, they're basically your drive-ups, especially in Chicago, you're outdoors.
Yeah.
So as an operator, you got to plow that snow. Somebody needs to get in. You open it up, it's snowing all over you, or it's raining all over you. So these new Class A facilities that we're building have the drive-ins, or at the very least, a drive up where you go in and the door closes behind you.
So it sounds like you guys, stage one is markets, research, making sure demographics align with what you guys know is the
Yeah,
criteria that needs to be present. Then it's right, I'm assuming site selection. So are you guys finding this dirt, just on the loop nets, the Crexies, the co-stars, and what's out there is, what you guys are going after and negotiating? Are you guys doing direct to owner, or sponsor campaigns to try and find sites? Or how are you guys getting, the clarity and the traction you're looking for when it comes to site selection?
sure. So we do use CoStar and Crexing. We've been doing this for a while, so we know a lot of brokers out there that are bringing us deals all the time. And truth be told, people just find us on LinkedIn. Like somebody that says, "Hey, I have a piece of property I'm thinking about, developing. Would you be interested in co-developing it with us?" We're working right now with a very large institutional landowner that has properties all across the country, primarily shopping centers that are looking to redevelop those. So we're talking to them, but we're data driven, right? So the most important thing when you're about to develop is you look for the population density. We talked about the income levels, the competition, saturation, traffic counts, and more importantly, the barriers to entry. Right, that's very important because and you know yourself as being a developer, when you have to entitle a piece of property or rezone it, that takes a long time, right? So if there's not self storage in that area, and that's kind of our expertise is going in, sitting down with the cities, and explaining to them why this would be a benefit for their community, and this scares other developers out, right? So we're effective in communicating our vision and our story to the board members of a community, and sitting down and saying, "This is what we're going to do, and this is why it's best for you." And sometimes we find sites that need to be cleaned up. Like right now, we have a site in a suburb of Chicago, had some EPA issues. It's been sitting as an eyesore to the village for many, many, many years. And we went there and said, "Okay, we're going to turn this around. We're going to build this beautiful self storage facility." And if we had something that was a little bit larger than what we're purchasing, then we put maybe a little retail strip center in the front to bring in some more revenue for the village.
I love that. So, kind of working through demographics, market research, then you guys are kind of going through site selection and understanding what goes into getting the property entitled to do what you want to do and making sure that it still, makes financial sense. Once you guys have that site selection, how are you guys analyzing, negotiating, structuring the deals, and what is it that you guys look for when it comes to kind of putting all those puzzle pieces together from an analytics perspective before you go and kind of raise, the equity and the final debt structures for your capital stack?
Sure. We so the first thing we do is we have internal software that we kind of do our own research and look at a couple things. The one thing that we look at, we by the way, we build only climate control facilities. So we look at what is the in-store rates for climate control in that 3 to 5 mile radius. So we look at what's advertised online by the Public Storage, Extra Space, Cube Smart, etc. We look at what the walk-in rates in, and then we create a model from there. Then the next challenge is, what do you build? Well, it's easy to say we're going to build self-storage, but are we building 900 units that are
Right.
10 by 10s, 10 by 20s, 5 by 5s? How do you price them? And that's where it gets really creative because you may want a 5 by 5, I may want a 10 by 10. And, what is that mix? How do you make everybody happy? Because once you build it, it's difficult to switch those. Now, can it be done? Absolutely. One of our facilities, our operator said, "Hey, I wish you had more 10 by 20s because all the 10 by 20s are gone and you have a lot of 10 by 10s left." Well, didn't take long to walk over there with a hammer and a couple screwdrivers and take some panels down, right? It's not that easy, but it can be done. So we just
Sure.
did that at one of our facilities. Going into our new facility, we're working with Public Storage, and they're checking with the regional managers in that area, and they're finding out what is the demand right now. And we're finding out that there's more 5 by 5. So we're shifting that, and we're working with the architect and our engineers to make sure we have the right mix. And then we also work with Public Storage. For this particular one, Public Storage is going to operate it for us. So they will run a model for me based on what they believe it'll take to absorb the units in the area, if that's a 2-year or 3-year process. And then we take their assumptions and we kind of make them a little bit different for us. If they say we'll fill it in 2 years, we'll stretch it out to 3 because we want to make sure that we have enough money raised. Because you need not only an interest reserve at the bank, but we like to have operational reserves that we leave at the bank as well. And then we have partnership reserves too. God forbid there was, an extra call that we miss. We have money that we don't, call out to the investors for capital calls.
So talk a little bit about kind of your equity stack, debt stack, what the overall capital stack looks like. That's maybe an average, framework for your guys' deals. And from a return perspective, on a deal level or maybe an investor level, what's kind of some of the, common metrics that you guys like to aim for in order for, hitting those performance hurdles that you guys are always looking for as an investor?
Sure. So let's just talk about a typical conventional financing deal. You walk into your local bank. So banks right now are doing about 70% loan to cost on these projects, which means we got to come up with a 30%. A typical project, depending on the land cost and how much earthwork needs to be done, I'm just going to throw out a number of $15 million. So we get about $10 million from the bank and about a $5 million equity check from the investors. And we typically syndicate these deals, and we'll get a private placement put together looking for accredited investors. And we'd go out and try to raise the capital, friends, family, your network, et cetera. Or we'd go to a family office that typically would write about 90 to 95% of that capital stack. And then we as the sponsors would put in that other 5%. It's not a family office, it's a fund. One of our last deals we did was a fund out of Portland, great group of guys. They saw our team, they liked the space, they wanted to get involved, and they came in to give us that capital stack. This week we have a meeting with the family office that's looking to invest in one of our deals. And then you have some guys out there that do high leverage debt. So call them a hard money lender, call them a equity participant. Some people have pref equity that they'll go in second place behind the lender. So that'll bridge the gap as well. And I try to look at all of these and then sit down back to my Excel and say, if I go the traditional way, 70% from the lender and 30% from the investors, what kind of IRR? I'm always targeting to give them a 20% or greater IRR. I feel that that's attractive. People hear 20% like, oh, okay. Also, we like to give a pref rate. And I try to give between 8 to 10% as a pref rate. So when I explain it to the investors, we'll say, okay, you guys get 8 to 10% yearly. And usually by year 2 or 3, we're able to have some cash flow to distribute. But you'll get your capital back first. You'll get any pref rate that's owed to you. Then we'll have a split above and beyond that. And that's negotiable. Typically it's a 50-50 split, but sometimes you might have to give more to the deal because the IRR is just not, you're not hitting it. But recently we're looking at possibly doing some PACE financing.
Okay.
I know PACE from my past. Also
those that don't know what PACE is, how would you explain that kind of bridge debt?
Sure. So PACE is a program that will finance 100% of items that are sustainable and energy efficient. But it's really pretty broad, right? So if you put a roof on there that has an energy efficiency of, XYZ, whatever that it is, or the windows, that qualifies. If you put in lights and you're walking and they're on sensors, they go on and off, which we have in our facilities, that qualifies, right? Your elevator, if it has the sensors in there, so it saves and conserves energy, that qualifies. The good thing about it, it gives you 100% on that piece. So if we had, let's say, $2 million of a $8 million hard cost construction, 2 million of that, which is 25%, is leveraged at 100%. Also, the great thing about that, it's a 30-year loan, and that loan is non-recourse, which is great for the developers.
Yeah.
It's also transferable to the next guy that buys the property. And you pay that, interestingly enough, you pay that through your taxes. You don't make a payment every month to the lender. So the municipality that collects the taxes usually twice a year also collects the amount of money that's owed to PACE, and they'll pay it to them on their behalf. So it goes on your tax bill. And then when you sell the property, you can sell that off as well. So why is that better? It takes me now from a 70% loan to cost. it probably bumps me up to about a 74% loan to cost. And that helps out. Traditionally, SBA is another great vehicle because now you can borrow 85%. And up to a couple of years ago, the SBA would not allow you to get an SBA loan unless you manage the property yourself. Because what's the purpose of an SBA loan, right? To help these small business owners.
Yep.
Well, even though we're small business owners, we're not operating it. We have a major REIT. So they view that as an investment, an armchair investment. But over the last 24 months, they're viewing it a little bit differently. There is some mechanics that you need to have on your operating agreement with your publicly traded company. But as long as you're in control of the money and you have some say so on the employees, it now fits under the SBA. So we're now thinking about going the SBA route.
Nice. That's great. I didn't know that SBA offered that on storage. So to your point, right, the operating model, I think is what box you kind of got to find a way to check when it comes to the SBA loans, right?
Yeah, that absolutely. No, they'd rather, if it was called Bill and Matt's self-storage, not a problem.
All day.
You say public storage and it's a multi-billion-dollar corporation, all of a sudden it's not a small business loan anymore.
Yeah. So you guys get the loan and the full capital stack put together. Walk me through kind of, and maybe just bring us up to the point that we're at right now, which is, let's call it, capital stack is there, entitlements are there, all of the architectural and, permits and everything that's, you got your contractor in place. What's generally the timeline of, we see a site and everything we just talked about to getting it to what we call permit and shovel ready, where you guys are, all the horizontal work is done. Now we're getting ready to go vertical and start construction. What's that timeline, and generally what kind of cost from the overall project? What's the cost percentage in relation to the overall project that you would say is a good rule of thumb for people to, understand?
Sure. So if it's a ground up development deal, once we go vertical, it's about, some of the contractors will say we'll have it done in 10 months. I always say 12 months. And it's really important where in the cycle you begin and what month and where you're developing, right? So here in Chicago, we have winter conditions. So nobody wants to be pouring concrete, in October or November. So you got to get that concrete poured. You got to get the steel, delivered and start erecting. And hopefully before the snow starts hitting, so that way you can kind of enclose it as everybody's working inside. If you're working, in Arizona, a whole different story, right? So you don't have those issues. If you're working in California and you have a lot of hard work, well, then you're talking about demolition and blowing up, some of the rock because you need to get those piers down. So it really depends on the area, but typically 10 to 12 months for a ground up construction.
Okay. So 10 to 12 months, you guys get it built, you get kind of the management team in place and ready to rock. How long until you get to a level of occupancy that you guys are feeling positive, and that is, from a net, cash flow perspective, got you guys back in the green and looking to move upwards to hit some of those return metrics you guys initially were aiming for and promising to your investors?
Right. So this is where it gets a little challenging and a little different than multifamily. So if we develop a multifamily and let's say in your neighborhood and you say, hey, Bill, in my neighborhood, a one bedroom gets $2,600 a month. I'm just making that up.
Yep.
When we open up, the doors in day one, you're going to market it at $2,600, right? Or maybe a little bit less. And you might give them the first month free. There might be some kind of incentives to get it in, but basically, you're going to get $2,600 from day one. And then you say, okay, the absorption rate in this area is, X amount per month. And I think I'm going to be at 70% I'm making this up again, in 7 months. The difference in self-storage is we give great discounts. So let's pretend a 10 by 10 is $185 a month down the street. We're not going to open up at $185 a month, which would be $1.85 per square foot per month. We might have to open up at $1.03. And so the model of a self-storage operator is let's get them in, right? Once they're in and they like us, they're not going to move out, right? Who's going to rent a truck for the day and take off a day work to move all this stuff out? So they wait 6 months and they raise your rent. So from $1.03, I'm making this up again, it might go to $1.23. So it's a 20% increase. And you might say, whoa, 20% increase, that's a lot. But if you look at everybody else in the neighborhood, you realize you're still paying a little bit less than everybody else is. So you stay there. 6 months later, they hit you with another increase. Eventually, they're going to get you to market, but it's going to take a while. And along that journey, you're going to lose people. And along that journey, you're going to get new people. So it's hard to tell exactly where that break even point is. However, I can tell you we have one that we opened up in November of 2022. We're at 74% occupied. It's paying the mortgage, it's paying the taxes. It's so considered to be, it's not profitable right now to the investors as much as it is, sustaining itself.
Mm-hmm.
As everybody's rates increases, that NOI drastically increases. And even though we're only at 74, the NOI at 74% today will be different. The NOI will be next year at 74% because we have all those increases that we just haven't done yet. So what I love about this is, it's kind of recession resistant, right? Everybody needs self-storage.
Mm-hmm.
Sometimes we talk about the 4Ds. People, when you go to these conferences, they're like, it's the 4Ds, it's the 4Ds. And what they mean by that is it's death, you got divorce, dislocation, and downsizing, right?
Mm.
And these are all events that happen in our lives. And at that point, we're going to need self-storage. So it's not going to go away, And people always say, you got to pay, you have death and taxes are the two things that you need. I say self-storage is one of those things. People need it. I have two. I have one for myself that I'm saving for my kids. I'm 60 years old. I have a 23-year-old and a 20-year-old. And they want to keep things. So when they get married, they want to bring it on. I have self-storage for that. I also have a trailer. I have self-storage for that. And more and more Americans are getting self-storage.
Do you see that trend changing at all? Right. I think some people have felt like, oh, it's oversaturated or overbuilt, or people are not storing as much stuff and they're less connected to material possessions. Right. You hear all these narratives, but when you really cut down to the data and kind of the facts, what are you seeing? Is that true or not?
We're still bullish on it. I don't think so. When we were in the car wash business and you'd see a car wash, open up a mile away, everybody would get, nervous and scared. And you're like, there's another car wash there. And all of a sudden it's like, we're still busy. So if you go around your neighborhood and you happen to see an extra space, don't be surprised if there's a public storage down the street, right? Same thing with McDonald's and Burger King. You see McDonald's and hey, there's a Burger King over here. You're giving the people choices, but people still need to eat and people still need to store their goods. So we're still bullish on storage. But again, you have to be selective. With interest rates now, they're not where they were a couple of years ago. When we were developing, we were getting rates at 3.75 and 4. Now we're at 7.5 and 8. So construction costs have gone up. Like you mentioned earlier, market saturation. That's another thing you got to be careful of. We're talking about tariffs now. So everybody is tariffs. The prices are going to rise. And you just got to build a good product and know your client. That's why I said, like in Chicago, we're doing the drive-ins now. So I'd rather go in there than go somewhere else where the elements are at play.
Yeah. And what's the overall kind of time frame on average life cycle of your deal from close to develop to stabilize to exit for you and your investors?
Well, we tell our investors a 3 to 5 year window, 5 being the longest. Typically, the loans have 5-year balloons, so we'll exit it before that. And that's our plan. And, a few years ago, we were selling these at a certificate of occupancy that kind of phased out a little bit, but I wouldn't be surprised if that comes back. Last year we had Extra Space bought Life Storage. That was a huge merger. And now we have a lot of funds that have been created specifically to buy Extra Space and put them in their portfolio. And then they're going to make their own private REITs. And Public Storage is, if you look at their financials and their quarterly reports, they're making so much money that their only thing they can do with them is buy more self-storage.
Yeah. Yeah, I was going to say, it seems like a lot of private equity, institutional capital, REITs, have all identified storage as a safe, steady, stable asset class that can clip a return that their groups and organizations are looking to get consistently. So obviously when you see big boy and big girl money consistently flowing into that space, it tells you that there's there's a reason behind that, right? They've got a lot of reason, a lot of resources, a lot of data that tells them that this is something that is worthwhile to park their dollars in. Any new trends or technology that you're seeing transform the space that you guys are paying attention to that, might insulate the business model or help, create, the product as an outlier to other competition and secure the safety of that asset and the returns a little bit more? What are you guys seeing out there?
Yeah, there's a bunch of things out there. So there's a lot of different locks out there right now that are really good. People forget their keys or lose their keys. You can open it up with your smartphone. So that's a great technology. They have sensors inside the unit. And what that does, it prevents anybody from closing themselves in the unit and staying there overnight. So unfortunately, that's one of the things that, people will try to do. But usually the manager will walk around and there's cameras in there. So it doesn't happen very often. But now they're putting systems in place so it can detect any motion inside there, which is kind of nice. I just came back on Friday from a conference in Las Vegas of the ISS show, and we saw a new technology there. It was interesting. I don't know if it's for us, but it was interesting. I liked it. For smaller operators to cut down on their expenses, they have a virtual assistant, but there's actually somebody there that you see, like a Zoom call, like we're doing today, right? So as soon as it shows up, it says, we'll connect you with a live agent. So the screen opens up and it's like, "Hi, Matt, how are you? What can I do for you today?" And you're like, "Hey, I'm looking for a 10 by 10. And usually they'll have them right in front of you that you can see. And they'll walk you through. This is what a 10 by 10 looks like. This is what it costs. And then she'll buzz you in and tell you to go look at one of the empty units. And then you decide to get it and you pay with your credit card there. You electronically sign your DocuSign there. And that not prevents, but it eliminates having a full-time employee there. And that person can, in theory, be watching 20 different locations, right? And they have a whole call center with all these technicians or sales agents, whatever you want to call them at. So that's very interesting. Now, public storage, I don't know if they'll go to that model. And we like to use the big boys. So again, if you and I had our own self-storage, you might say, "Hey, we could save a few $1,000s a year. Let's do this."
Sure.
And that makes all the sense in the world.
Sure.
When it comes to a publicly traded company, they may or they may not implement those changes.
Yeah. You seen AI make any penetration into the self-storage space? I know it's a relatively low operational and management intensive model if you set it up the right way. But what are you seeing in terms of, is AI disrupting the space at all? Or how are you guys kind of paying attention to and leaning into the future of AI and how it might impact this investment vehicle?
Yeah, I like AI. I was, when it first came out, I was not necessarily a naysayer, but I was like, AI. But it's doing research for us fast, like really fast.
Yeah.
So I was at a breakfast meeting the other day and we were talking about boat and RV storage. So the new thing we're doing now is boat and RV. And we were trying to figure out, how do you track boat and RVs? Like, who's buying them? Where are they storing them? Hey, let's ask ChatGPT, right? So we asked ChatGPT, and in a matter of seconds, it said, "Well, this is what you could do. You can go to the DMV, and you can look for registrations to see where they register them once they buy them, because you want to have your location within a 10 or 20-mile radius of where people own their RVs." So I think for developers, it could help us identify some stuff, or at least answer some questions faster.
Yep.
On the operations side, because we don't really do the operations, I'm not sure if public or extra space, what they're doing to implement those. But I think they're putting them on their sites to answer questions for their customers, right? Like, what problem do you have? And here it is. Here's a quick answer. Does this solve it? If not, maybe we can get you to a live agent. But it's definitely going to change. And I think it's changing a lot of things in the world.
Well, Bill, I know a lot of people are going to be interested in your guys' development opportunities, your overall model. You guys put out some great stuff. For those that want to inquire more, where's the best place for them to reach out and connect with you?
Oh, perfect. They could email me directly. It's CFO at self, and then we got the hyphen or dash storage developers.com, or just go to our website, self-storage dash or self-dash storage developers.com.
And we'll
Love
link
to talk to your listeners.
Yeah, we'll link all of that up in the show notes, show description down below, and the show notes at millionairemindcast.com. Bill Kanatas, thanks for coming on the show, brother.
Oh, I appreciate it, man. Thank you so much. Love you. I love your show, by the way. Thanks.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow, you want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.